Hello and welcome to this YouTube channel for ACCA FR exam prep. My name is Adam. In this video, I'll be taking you through how to account for exchange differences arising on non-monetary items. Let's look at the details of this question. To start with the requirement, what is the initial? So we have what is the initial? So let's see. The initial, just the initial and subsequent measurement for the plant and equipment. So let's see. Airco is a public limited company with a reporting date of 31st December 2010 and a functional currency of dollars. Very important. On 30th June 2010, it purchased a plant and equipment from an overseas dealer at the cost of 30 million dinars. So 30 million dinars. Airco uses the cost model to value PPE. So cost model, no revaluation. Very important. It is the cost model, so the asset to be carried at its depreciated cost. Now the exchange rate between the dollar and the dinar, so on the 30th of June 2010 is 3, and on the 31st December 2010 is 2, and we have average rate for the year 2.5. The plant and equipment had a fair value of 32 dinars at year end. So with this information, we need to extract relevant information to use to answer the question. Now, for non-monetary items, the rule is that at initial measurement, translate at spot. So we are translating at spot rate. Now, for this question, the spot rate, which is the date of the transaction, is 3. And between these two currencies, dollar is of more value relative to the dinar, and the entity's functional currency is dollars. So if you translate, you should get less of the dollar because the dollar is of more value relative to the dinar. So very important. So here it means that when we take the dinar value, we have to divide using the exchange rate to get the dollar. So this is what you will do. Let's see. Again, the date, very simple. Sorry. So what I will do is to bring the date. The dinar or dinars in million. Then I'll bring the rate, and I'll bring the dollar also in million. The date is 30th June 2010. The value was 30. The rate was 3. It means we should have 10 million because this should be 30 divided by 10. 30 divided by 3. Sorry. 30 divided by 3. So 30 divided by 3 should give us 10. Now, note that for the subsequent measurement, the amount of the asset under the cost model is not retranslated. So what I would say here is that at 31st December, this is 30th, at 31st December 2010, no retranslation. Under cost model. So the asset value will still be 10 at the reporting date. Then the relevant depreciation will be calculated. Now, however, if the question or if the entity were to be using the revaluation method, let's see how this will be. So I'll just do it simply here. If they were to be using a revaluation method, this is what will happen. On the date here, the translation would be, on this date, the translation would be 30 divided by 3, and that will give us 10. Then at the reporting date, we would have to retranslate using the revalue, which is the fair value. So it will be 32 divided by the rate prevailing, which is the closing rate, and that is 2. And this will give us, so 32 divided by 2, that should give us 16. And what it means is that between the initial date and the year end, due to the effect of revaluation differences and exchange differences, the value of the asset has gone up. So therefore, we'll have a forex gain of 6 million. And this difference will go to OCI, not P&L. This difference will go to OCI, not P&L. I hope this helps you in your preparation for the FR exam. Please subscribe to this channel to receive updates on latest videos.